Hello friends, in this edition we want to discuss about our arbitrage funds. On the onset, before we start, let me wish everybody a very happy new year and a prosperous 2020. We have been joined by our fund manager Mr. Lovelish Solanki,
Hi.
who manages our arbitrage fund. Welcome Lovelish.
Thank you.
Uh, Lovelish, of late, we have seen arbitrage funds has been very popular in the industry, and our viewers would be happy to understand it better and how does it work. So, just to start with, can you please help us understand how this arbitrage funds, or basically the strategy, how does that work, and how is it useful for our investors?
Okay. Arbitrage funds are equity funds which deploy arbitrage strategy. It's a plain vanilla cash future strategy wherein one buys in the cash segment and simultaneously sells in the future segment. The spread between the futures and cash segment is what the investor earns. The major portion of the fund is invested in this cash future strategy, and since it is into the equity segment, it is also classified as equity fund. The remaining or the small portion of the fund is invested in the debt side. These are highly rated debt papers which help you to generate a regular income on that particular portion. If you see on a net basis, the fund has zero directional exposure to the market.
So, when we talk about our ABSL arbitrage fund, is it anything different, or how does it manage money for us? Okay.
Given the mandate, we deploy only market neutral strategy while ensuring there are no directional exposure to the market. So broadly, if one wants to see this category as a strategy, so there are two parts to it. One comprises of equity segment, second is the debt part. Now, when it comes to ABSL arbitrage fund, in equity side, we only take market neutral strategy while ensuring there are no directional exposure to the market, which means all our positions are 100% hedged against the same underlying. Now, when it comes to debt, again, debt can be divided into two parts. One is the active debt and the second is the passive debt. What do I mean by active debt here is the duration and the credit side of the debt. Given our conservatism, we don't take any kind of duration or credit calls when it comes to the active debt side. So the passive debt side, what I mean here is the short-term, highly AAA rated bonds or CPs, which are more used to manage the daily liquidity. There is a small portion also with regards to the margin FD. Margin FDs are nothing but the FDs which are created with high quality banks to keep as a collateral against the futures margin with the exchanges. So when it comes to margin FD, we place it only with the high quality banks. So in a nutshell, if you see, we don't intend or we don't take any kind of position which brings volatility along with it. From the historical data, you can see that we have always provided the lowest volatility within the category.
Just as a follow-on, when we talk about market neutral strategy, what is the kind of risk profile the fund has?
As I have stated earlier, when it came to the strategy part, there are two parts to the strategy. One is the equity and the debt side. When it comes to the risk profile of the fund, the only risk which I can see which emerges in this space is from the directional exposure if one takes in the market. So the moment you deviate from the basic strategy or the complete hedge part of it, you call for a additional risk to the fund. As I have stated earlier, at Birla Mutual Fund, as a matter of policy and prudence, we don't intend to take any kind of directional exposure to the markets. The same stands true when it comes to the debt side of the portfolio. We don't take any kind of duration or credit calls in the fund. So that clearly states that we don't want to bring any kind of volatility in this fund, and hence I don't see any kind of risk apart from these spaces.
Lavish, what kind of investors do you think one should invest in arbitrage funds, and why specifically in ABSL arbitrage fund?
Since we don't take any kind of directional exposure in the market, this is one of the lowest risk category one can invest in. So considering the investment risk profile of the same, I think conservative investors who are seeking safety and predictable returns with better tax efficient ones should definitely look into this space. Also, we have a strong record of paying regular dividends.
Before we sum up, one last question, in terms of a broader aspect. Going forward, liquid funds are expected to yield lower in the lower interest rate regime. Do you still advise our investors to invest in arbitrage funds?
Let me just put across one point very strongly. Arbitrage funds, in a way, interest rate derivative product. So, arbitrage funds have a very strong correlation with the prevailing interest rate in an economy. When I say that, which also means that it has a very strong correlation to the short term rates. Now, as I mentioned earlier, a small portion of the arbitrage fund is again invested into a debt part, which means that somewhere they are correlated to the interest rates which are prevailing in an economy. So, a major portion of the fund is derived from the interest rates which are prevailing in an economy. Now, in a given scenario where the interest rates are tend to lower, what we have seen historically basically is, in both the cycles this category has fared well, while in the up cycle as well as the down cycle. Let me restrict myself from putting across a view of whether the rates are going to go up or down, but we have a very strong history along with us right now. Also, it has a very strong correlation with the underlying sentiments in the equity market. So, considering these 2 points wherein, so the category has a strong correlation with the equity markets as well as the strong correlation with the interest rates, it is safe to assume that, this category can fare really well even going ahead when it comes to liquid fund, as the category is having the similar risk profile that of the liquid fund, and one can have the safety, the predictability and a better tax adjusted returns when it comes to arbitrage vis-a-vis liquids.
Lovelish, let me tell you, this was quite detailed and insightful. I hope our viewers have enjoyed this, and thank you, Lovelish, for your time.
Thank you.
Thank you, investors. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.